Hey guys, and welcome to the first installment of Fun with Financial Modeling with Sumit. It might be the last installment, who knows? But today I'm going to walk you through building a basic financial model using a template that's on my website, sumitkapoor.com. Basically, a bunch of friends had asked for a basic template, and I put it together, and I thought I might post it on my own website as well. So we'll go ahead and get started. Start up by just opening the financial model and enable the macros. There's only one macro, and it's pretty simple and very useful. And go ahead and just make it as big. Um, the first thing I would advise you do is go into preferences and click on error checking and make sure that all of these are unchecked. Otherwise, you get a bunch of green triangles that are marginally useful at best. So right away, you're in the main page. This main page has a lot of the assumptions and some of the high-level results. But let's go right into the guts of the model, which is these three tabs: IS, BS, and CF, which is income statement, balance sheet, and cash flow statement. The purpose of this model is to project your income statement, balance sheet, and cash flow statement, which are the three main financial tools, financial items that are projected in most financial models or the main financial statements. The two that you really care about are income statement and balance sheet. The income statement shows basically your income, which is flows over a period of time. So let's say for 2014, this is the total sales that occur in that period of time. Revenue, cost of revenue, operating expenses, and other expenses. The balance sheet, on the other hand, is the snapshot at a point in time. So this is your assets, your liabilities, and your equity at the end of 2014, end of 2015, or end of any given month. And the way a balance sheet works is your assets are what you have of value, your liabilities are what you owe to other people of value, and equity is what's left over. So assets equal liabilities plus equity is the basic financial equation. The cash flow statement is important, but basically it's just derived from values in the income statement and balance sheet. So realistically, the two main financial statements are income statement and balance sheet. And the way these two relate is that the income statement gives you net earnings, and net earnings, net income here, flows into retained earnings. So your change in retained earnings from one period to the next is the previous retained earnings plus the net income from the from the income statement. So they're very interrelated, and these are the two main guys that you're going to care about. Let's go back to the main tab. The main tab has high-level results. This is what you're projecting. Four key metrics: total revenue, EBITDA, earnings before interest, taxes, depreciation, and amortization. It's a key value used in a lot of multiples for valuation. Net income and cash at the period end. And then there's a bunch of assumptions down there. Ignore this saved and summary minus saved. We'll get into that later. But the assumptions that we'll go through will drive the entire financial projection. So you'll have revenue assumptions, expense assumptions, and other assumptions down there below. Let me take a quick step to go over some high-level things. I'm going to be trying to teach you how to fish and teach you how to use the model and teach you how to financial model in general. So I'll be giving tips. The first is I always try to make sure that my model looks nice. And the reason for that is if there is questions around consistency in formatting, if there's questions around things looking sloppy, then people start to question the content. So it's very important to make sure things look nice. And to that end, I have a few styles, very few. Header 1, header 2, row header 1, row header 2, and row header 3. Very basic stuff. And I use indents. So here you'll see, under revenue, I use this indenting button or dedenting button to put sub-items underneath there to make things easier for the user to follow through. Second, try to make things as simple as possible and understandable. The reason for that is if people don't understand what's going on, then they start to question the results as well. So, Einstein said, make things as complex as necessary, but not one bit more. So try to use that in your financial modeling. And the third thing is try to make your models as dynamic as possible, which means that if you change yellow cells, which all inputs are in yellow, so really you should only be mucking with the yellow cells, until you want to change the structure of the model, which I highly advise you get into and understand what's going on in the formulas. But if you change the yellow cells, then it'll change the results. And if you make the model dynamic, then you can see how your business strategy would affect your financial results. So let's get into it and start building a financial model for a company. So first, we'll choose a name for our company. Today we will make Bob's company, which will be Bobco, which will be kind of a software as a service, platform as a service, buzzword compliant company. Um, First model month end. Make sure you choose a month end for this, but we'll start in the beginning of 2014. So the first month end would be 1/31/14. And we'll go ahead and start filling in some of our revenue assumptions here. Bob is going to be charging $10 for each uh, sale or subscription, whatever you want to call it. And the direct cost, given that it's software, you don't have a whole lot of raw materials, you might have some payment processing fees. So we'll go ahead and put 3% in there. As you can see, no revenue is coming in yet. And that's because we haven't done any marketing. We don't really have any sales. So now we'll go ahead and change that, and we'll fill in outbound marketing, inbound marketing, channel partner marketing. We might fill in ad sales revenue, and we might fill in these user-based assumptions down here. So I've already done a bunch of these before on this Bobco tab. So I'm just going to be copying and pasting. You don't have to do that, obviously. You can just fill in whatever you want in the yellow cells. So first we'll fill in outbound marketing. So you'll be spending this amount in any given quarter. So for example, in 2014, third quarter, you'd spend $5,000 a month, and it would buy you a certain number of impressions at this CPM. Those certain number of those users would click through to your website, and then a certain number of those would convert into actual sales. We'll go ahead and also get inbound marketing, because Bob's no dummy. He knows that today it's all about being social and spending some money on getting users engaged. We'll also go ahead and create a partner marketing channel. And these partners will market your product on your behalf, and you'll pay them a certain fee, dollars per sale here. And this is the number of active partnerships. So a partnership would ramp up to over 3 months, 500 sales, and then it would continue to grow at 20%. So within this whole section, you're going to start to understand how it is to model things, and I'll show you exactly where these flow through to in a second. We'll grab some ad sales. Bob's going to have a little bit of ad revenue here. Some models obviously have all ad revenue. Some models have none. Bob is kind of a hybrid operator. And he's also going to have a certain number of sales to existing users who attrite or leave at 10% per year, but a fourth of them will will buy in any given year. And then he's also going to have viral marketing, which is super important. As you'll see, it's a very sensitive assumption, and actually what happens with viral marketing is each new user sends out invitations. Some portion of those invitations convert, and the product of those is the coefficient of virality. Anything above 1 will start to give you massive growth, exponential growth, in fact. And if you want more details, you can just Google David Skok, S-K-O-K. He's done some really good write-ups on this. But now you'll see we all of a sudden have a bunch of revenue. We have $7 million in revenue in 2017. Over the projection period, we have $10 million in revenue. We have EBITDA, we have net income, we have cash. The way this happened is all of these assumptions drove sales. And on this sales page, you'll see marketing-driven sales from each of your channels, outbound, inbound, and channel partner marketing. You'll see user-based driven sales, user-based, sales to user-based, and virality. And then you'll see total sales. And for each channel, I calculate the customer acquisition cost. I know I'm moving really fast here, but feel free to go into each one of these cells and understand what's going on. Some of the very important functions that you're going to want to know are VLOOKUP, which looks up a certain value. So in this case, it would look up how much marketing is spent in this given year, in this given quarter. Another function to get to know would be index. Index is very similar to VLOOKUP. HLOOKUP is an important function. SUMIF and SUMIFs are important functions. Those are things to get familiar with in Excel. But here, your sales are now growing as a result of the marketing you're doing. And in fact, you're getting all these new sales, 230,000 in 16, 666,000 in 2017. And it's driving all sorts of revenue. And you'll see there are yellow sections within each one of these individual tabs. Feel free to put whatever you'd like there. Those are also inputs. You might have other revenue streams. You might have other costs of revenue. Here you'll see direct costs from that 3% we put on the main page are coming in, but there's still no operating expense, um, and the balance sheet is flowing through as well. You'll see cash is now starting to come into the balance sheet as a result of the sales that we're making. So we'll go back to the main page, and now we filled in a lot of these revenue assumptions. I'm going to now show you one of the tools in this sheet. If you click this button, Summary to Saved, what happens is Excel will start to convulse and actually do a little macro that will save down the results from this particular projection. So you have these two sheets here, Summary and Saved. Summary is basically high-level details from your income statement and your balance sheet. It just literally pulls these from the income statement and the balance sheet in just a more high-level format with less granularity. The reason this is important is it's very nice to be able to see this at a glance, and it's often useful for pasting into PowerPoints, etc. Saved is just the exact same thing as Summary, but just pasted values so that you can keep track of a particular scenario. And that's useful because then you're going to be able to see how you change yellow assumptions and see the impact that they have in Summary minus Saved. So you see right now, Summary and Saved are the exact same thing. So we'll go ahead and use that because now we have to have some expenses because we haven't hired anybody or done anything in terms of hosting or anything else that is required in order to sell something. So we will go ahead and take these expense assumptions from this page. As I mentioned, I've already filled in some of this stuff before, and all I'm doing is pasting values, but you don't have to do that. Here, this is total number of engineers, the total number of engineers in any given quarter, and the ratio of junior to senior engineers. Here, you're going to be looking at the business analysts and managers, just random guys to have around. You'll also want some biz dev guys. That's going to be driven a little bit differently. It's going to be based on the number of sales, and the customer support staff is also going to be driven off of the number of sales. And I have listed salary levels here that I'd already filled in. Other payroll assumptions, payroll tax. This is what employers pay. Employers actually have to pay a portion of taxes on top of what the employees pay. We also have IT phones, rent, travel and entertainment, insurances, and I'm going to fill in a minimum here for insurances. You also have hosting fees. Hosting fees obviously scale as you grow. So this functionality here enables that to happen. So you have a starting point. You have a point at 10,000 monthly sales, $10,000 for instance here. But each additional 10,000 only costs you $2,500 because you're scaling. And now that you have departments, you also have budgets. So we will go ahead and specify the budgets for each of the given departments. That's above and beyond what would come up in other areas. For instance, marketing had to spend up there, but they also might have some other budget that they're looking to spend. So now we've gone ahead and filled in all these expense assumptions, and you scroll up and you see, okay, as a result of what happened, our EBITDA fell by 4.5 million in 2017. Our revenue didn't change, right? Net income dropped significantly. Cash dropped significantly. So what happened is we started to actually have some expenses, and that influenced our financial projections. So if we go over here to the balance sheet, for example, we'll see cash starting to drop from day one because you're not really generating enough revenue to cover your cash burn as any business would have to make an initial investment. So what we'll do is we will go ahead and rectify that by raising some capital. So again, the balance sheet has assets, it has liabilities, and it has equity. The capital that you might raise initially would be company debt, let's say. And so Bob is going to go ahead and raise $300,000 of company debt right away from Angels or his own credit card. Bob's a big hitter, so he's got plenty of cash. So he puts that money to work here, and you need to keep that. If you would have 300,000 here and then 0 here, the model would assume you paid that debt back. So don't do that. And you see now the amount of cash actually is positive, 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 and then it goes to negative, right? So Bob is going to need to go ahead and raise some venture capital. So let's say Bob out here raises, 5 million in venture capital. and carry that through. Bob does this really fast. Bob is one of the most well-connected people out there. Bob's just the man. And then after that $5 million, let's say out here he raises another five, bringing the total amount of equity to 10 million, and that would be Bob's Series B. So we'll take that all the way through. Equity is obviously not paid back in most cases. You do see this line here, assets minus liabilities and equity. That should be 0. That means the balance sheet is balancing. If it's not, then there's something wrong with your model. So I've just grayed that out. But now we do have a lot of the main assumptions filled in, as well as a capital raise. One thing we didn't do is fill in corporate employees. This staff expense line is pulling in employees from that main assumptions page. So product development, for instance, we had specified 2 engineers right away. Here they are, and here's the cost for those guys. And then biz dev and other guys will come in accordance with those main tab assumptions. You also might have these guys. All this page is yellow, so you can do whatever you want. This yellow section here that I'm mucking with right now is not going to be there in your model, but it's just there for me to make this kind of quick. And I just pasted the values there. So now what's happening is we have a CEO starting in, we're going to start paying Bob in July. So he works for 6 months for free. We hire a COO at the beginning of 2015. These guys that are 1/1/20 start and 1/1/20 end, the model's just going to say, look, they don't exist for the purposes of this modeling period. So none of that will flow through. But this will use all the different assumptions from the main page in terms of payroll taxes and benefits to fully load these employees. So now let's come back and take a look at how things are looking with the new capital we raised. Now the cash situation is pretty healthy, right? Because Bob had raised all that venture capital, and actually EBITDA is, in the beginning it's negative, but he starts to turn a profit in 2017, both EBITDA wise and net income wise, and so we'll go ahead and save that as a saved set of assumptions. So this is a good base case for Bob. Feel free again to go through these assumptions, understand what's going on, and look at what's happening on the individual tabs: income statement, balance sheet, and cash flow statement. Where's the money going? And try to understand what's going on in these individual formulas. Here's an example: index main, blah 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 blah, which basically means it's looking up what's happening in 2014 for the legal budget. For 2014, which was listed here in the legal budget. So all those assumptions are going through. Now again, to try to tweak things a little bit, let's just see what happens when we change some assumptions. So virality, I said, was something that's super sensitive. Let's say instead of sending out 5, you get the new users to send out 6 invitations. Boom. All of a sudden, your revenue's up by 2.8 million in 2017. EBITDA's up by 2.2 million. Things are starting to look really good for Bob. One thing we didn't look at too much was the cash. So just you can look at the trend line for cash. You see, obviously, he raised the 5 million, and it goes down, down, down. But then he raises another chunk, and there it is, and it's going down, but he turns it around, and it starts going up. So, and you can see that as well on the cash flow page. You can see where net income is your base for the cash flow, and then the other operating accounts would cause other changes in cash. Investing cash flow would be, for instance, fixed assets. So fixed assets, you could specify that on the balance sheet page here. If you would, for instance, need to buy some machinery or something like that. And then financing cash flow, you can see the impact of those capital raises. Here, debt financing, $300,000 flowed in. Here's $5 million from the equity raise, Series A, and over here should be another $5 million from the Series B. So all these cells are being pulled dynamically. The whole model adjusts dynamically, just based on what you do in those yellow tabs, and those yellow cells. Sorry. So, we did this one change, and all of a sudden, Bob is, jamming. He's got $9.7 million of revenue. He's got a real business on his hands. Another change we might make is rather than just selling them once, let's say it's a subscription that lasts 12 months. So first we'll just save down this assumption so we can see the impact of just that one change. Click that button, let Excel convulse. And what we're going to do is we're going to say, you know, that they're going to pay $10 every month for 12 months. And boom, Bob is now at a $73 million company. Obviously, it went up by $63 million in terms of revenue. So obviously, selling someone $10 one-shot deals is not nearly as large a company as telling them a 12-month subscription at $10 a month. So that's what we did there. We'll go ahead and undo that. And down here, I'll go through a couple other things. Ratio of junior to senior. This is used to calculate how much these engineers cost based on the salary levels that are down here and the annual increases. You also have a couple of other assumptions that are a little bit more complicated. AR at month end as a percent of revenue, AP at month end as a percent of revenue. That's accounts receivable and accounts payable. Accounts receivable means that you don't get all the sales in the month that you sell, so you're going to be collecting in over some time period. Accounts payable means that you don't have to pay all your expenses in the month that they accrue. So that's used in order to calculate and forecast the balance sheet accounts here, and which imply changes in cash flow. Again, all this stuff is dynamic. Here are some yellow cells. You can feel free to put whatever you want there, and it'll calculate. Also on the main tab is the interest rate on company debt. We raised that $300,000 of company debt. We're paying 10% interest on that. And you have the corporate tax rate. Taxes are all calculated in here. And what happens is initially you really start to build up a tax asset. So we're losing money and we have negative taxes. So what happens is you start to build up this net operating losses, this deferred tax asset, meaning in the future when you do start to make money, you don't have to pay taxes right away because you can claim that all those losses from the past. So this asset builds up over time, and then eventually it starts to go down as you really start to eat into it because you started making money. So that's the high level on this financial model. Feel free to experiment. If you have any questions, feel free to reach out to me. Don't be offended if I don't respond. Bobco is a busy place. Next steps are, go ahead and build out your company, your startup, your dreams, and eventually actuals and things like that will be integrated into a model like this. But for now, hopefully this is a useful tool for you to project and be able to convey the ideas about what your business is and could be through financial projection. Good luck.